couple of minutes past, so let's get started on today. Hopefully you've been to these webinars before. We've been running them now for 12 months, but they are designed to be a real help and guide for you in terms of your journey on launching and growing your private practice. So we've covered lots of different areas, which I'll come onto in just a second, but the idea is really to help you through those different stages that you might be going through, help you avoid the common pitfalls and mistakes, helping you save time and money by understanding the processes that you should be going through, and making the right decisions at the right time. And hopefully that will help you launch quicker and start to see those patients sooner and bring those revenues in the door sooner than you think. So that's what really they've been designed for. And we've covered a lot of different topics. This is just a kind of selection really over the last 12 months of what we've covered, everything from planning for private practice through to marketing, CQC registration, which we'll be coming back to next month in April and May, and we'll talk more about that a little bit later. We've covered video, medical indemnity insurance, search engine optimization, and the last couple we've had, one was being with Doctify on the power of patient reviews, and then Vicky hosted one last month on how UK doctors can pay less tax in 2025. So, and to follow on that theme, today is all about finance again and investments. So for those of you that are unfamiliar with Designated Medical, we are a full service consultancy for private healthcare. We only operate in private healthcare. We have a full range of services and teams that specialize in everything from accountancy and finance, which Vicky heads up, through to our new team within CQC registration. We have a resource team around allowing sort of appointing kind of medical virtual PAs, practice managers, marketing managers, finance managers. We have a medical billing team, marketing. So everything that you may need relating to private practice, we've got that team of specialists in the background. And the idea really is that allows you time and focus to be able to focus on the patients, and allows us to kind of look after the areas that we know best, and ultimately to help you launch and grow your private practice with confidence and competence. This evening, we are joined by Vicky, who you met last month if you attended back in February. Vicky's our CFO and a qualified management accountant. We're also delighted to be joined today by Oliver Pereira, who is a senior partner of Clearwater Wealth Management. He provides financial planning advice to professionals, business owners, but especially doctors in the private sector. So you'll meet Oliver in just a second, and you'll be familiar with myself. I host these webinars. I'm Simon. I'm the CMO at Designated Medical. I specialize in helping doctors set up their private practices. I've been doing that for the last sort of 5-6 years. And yeah, you'll see me on every webinar that we do. So, but today the theme is all around preparing for the new tax year on April the 6th, and how to optimize your financial management practices. So Vicky's going to go through some key tax deadlines and updates for you, the dates that you need to make sure they're in your calendar, thinking about best practice for your kind of finances for your private practice. So thinking about your kind of income, expenses, recording receipts, those types of things. And then Oliver's going to talk a little bit more around maximizing your tax efficiency, including pensions, allowances, thinking about payroll versus dividend tax, and some ideas and thoughts relating to investments. So now is the time, I think, with April the 6th just around the corner. So I will now pass you over to Vicky. Vicky, do you want to start? Is there anything you want to add?
No, good to go. Hi, everyone. Nice to be back for my second ever webinar with Designated. I thought probably we would start off to just go over some types of tax. We did cover this on the last webinar, but I think it's something that it never gets old. There's always a new type of tax that's coming. Could we just pop onto the next slide, Simon? Thank you. So everybody knows about income tax, obviously basic, higher, additional rate. National insurance, although it's not classed, well, it is a tax, but nobody seems to think it's a tax. There is pension tax, there is capital gains tax, which everybody obviously hates, and there's some changes coming up on that. Dividend tax, so for investments or to withdraw capital out of a limited company. VAT, self-assessment return, which obviously has just passed the 31st of January, but we are already planning for next year. And then corporation tax, so for limited companies, that's due 9 months after the year end. So what I do, one of the major things when I meet new clients, we sit down and we look at tax preparation, key dates, and a lot of the time it's just not clear. Like, is it April? Is it January? What's this about July? So what I always do is I sit down with them and we literally diarise important dates. So 5th of April is the last day of the current tax year, which is obviously coming up. 6th of April is, as we call in the accountancy and finance world, New Year. And then the 31st of July is a special date for two reasons, but it's one that is always forgotten. For the first reason, it's the second payment on account for self-assessment payees. And also, it's the last day for benefit in kind. So, anyone who has anything like company cars that are taxable, private medical insurance, the P11D needs to be issued by that date. And obviously, 31st of January, self-assessment deadline date. Corporation tax is not as easy to say when your date is because it's 9 months from your financial year end. So a lot of businesses probably are the end of March, but again, they can be any day, any end of any month. So, if they are March, then it's 9 months after that, so 31st of December. But we diarise all of this information for our clients because we find it just so much clearer for them. So one thing I'd like to talk to you about tonight is something that with the new year coming, it's about making plans to be more tech savvy, to obviously save yourself time. So looking at how financial software has always been viewed as, oh no, I don't need that. I'm just a small business. But actually, it is really, really important. It cuts back manual work. The fact that we have to go back to clinicians saying, please, can we have your bank statements? Please, can we have the receipt for this? Can we have this? With software, you don't need to do any of those things. Everything is there. You can have manual automatic bank feeds rather than manual bank statements. So all of the data is live. There's image capturing software called HubDoc, and that can be used in conjunction with our brand partner, which is Xero. We use Xero for all of our accountancy clients, but also all of our bidding clients as well, to ensure that we can have live data to be able to obviously mark off receivables or to be able to check that credits have gone through. It's really, really important. And I think, it removes the need for any paper. You do not have to keep this 6-7 years worth of paper if you are using cloud software. And, I can imagine, people, I've seen offices where people have got, bags or folders up to here where they're keeping all of the information because they just don't know what to keep and what not. Anything like this, cloud-based is the way forward. It really does free up your time. So I really think it's something that if you are moving, after the 6th of sort of April or your tax year end is coming for your company, if you're not using software already, it was something that I would really advise you to have a look into. And then one question that I get asked quite a lot is, I'm doing private practice part-time, so therefore I just take dividends. And then obviously maybe change the circumstance down the line. Actually, I'm now pretty much full time. How do I do that? Would I be better on a payroll? And sometimes I think they can be a little bit misunderstood of what the difference between the two. So dividend tax, you don't need to set up any schemes or anything. Literally, as long as you are registered as an employee, a self-employed person, and you are a shareholder or director of the limited company, you can draw dividends. They are exempt from national insurance. You don't have to pay national insurance on them. It is literally at the rates of 8.75, 33.75, and 39.35. There's a £500 tax free at the beginning. But the big thing to understand is you can only take dividends if profits allow. So if you make a profit of 100k, you can take 100k. If you make a profit of 50, you can only take 50. You can add family members on, but they have to then be a shareholder and you're giving away a percentage of your business in effect. Payroll tax, a PAYE scheme must be set up, and generally an accountant would do that for you. They would run you a monthly or weekly payroll. This does attract national insurance, but those national insurance costs can be deducted from corporation tax and they are fully trade expenses. So they are fully tax deductible. And as before, the rates are 20, 40 and 45. Again, you can add family members to your scheme and pay them. Whether or not they do admin work for you, weekend work for you, they can be put onto a payroll and you can, again, fully expense those costs. It's worth noting we did discuss it in last month's webinar, but there are going to be some employment changes for employers' national insurance going up from the 6th of April. But again, these costs can be capitalised into the P&L. And I think I'm going to pass you over to Oliver now, who can give you a lot of important information.
Wonderful, thank you, Vicky. Good evening, everyone. My name's Oliver. As mentioned at the start, I'm a chartered wealth manager and senior partner at Clearwater Wealth Management. So I'll build on a few of these points that Vicky mentioned. All of the taxes that were mentioned. My job is to help you minimize them or avoid them, or at least hold on to more of your profits. What we've got here is a bit of a wheel of the services that we're able to provide. So business growth and exits, investing activities, looking after your workforce and managing sort of business risk. For the purposes of this evening, I'm going to focus on some of the more interesting parts, which is the bits around retirement planning, pension funding, tax planning, corporate investing, and capital extraction. We look at the entire picture for everyone, but for the purposes of this evening, we'll just focus on these parts. So moving on to sort of structuring your profits on the next slide here. So once the work is done, invoices are paid, staff insurance is paid for, other expenses. The ultimate question is what do you do with your profits? This is where we can assist the best way to distribute and grow this money for a future date. There's a couple of ways to do this. Obviously, firstly, life has its expenses. There's mortgage to be paid, school fees, general living costs, holidays. Obviously, all of this stuff has to be paid for first. But hopefully, there's a little bit left over. So what do you do with that? You've got a couple of options. First one is investing within the business. So not extracting the profit from the business, keeping it within the limited company, and investing it that way. The other option is getting it out of the business. So that would involve paying yourself a dividend or some sort of payroll situation and investing the monies in your personal name. And pensions are a really key part of that, which I'll focus on and dive into deeper on another slide. But if we start off with personal investments on the next slide, I'm going to take you through a kind of almost sort of shocking worst case scenario of how to take money out of a business in what I would almost call the worst possible way. So if we start off with, and I'll try not to go into too much detail here, but if we start off with 50,000 profit, worst case scenario, that's going to attract 25% corporation tax. So immediately you're down to 37,500, 12.5 has gone off to HMRC. You've now got 37.5 free and clear in the business, but you need to get it out. You need to get it into your personal bank account. The most likely way you're going to do so is by paying yourself a dividend. And the worst case scenario there is 39.35% tax. And as you can see, that first bold number there, 22,743 remains. Quick maths tells us that's more than half gone. You've paid £27,000 to HMRC, 54.51% is gone like that. Its money is now in your bank account. You've got a choice in terms of investing. Overpay the mortgage, fund your ISA, general investment account, rental property into a savings account to earn the interest. But hopefully you can see with this example, paying that much tax shouldn't be so enticing as an option. There are better ways, which we'll talk about on in the personal pension section. So what we've started with is contributions straight from the business. These are counted as an allowable business expense. So this is the same as paying staff. This is the same as paying insurance. It is a deduction to your profit. That means, based on our last example, you don't have to pay the corporation tax on that money. It goes off to your pension. You're also then avoiding taking the money out of the business at that time, potentially avoiding the highest rate of dividend tax as well. By saving both of those taxes, you're guaranteeing yourself a return of roughly 120%, which is a pretty good result. Obviously, this incredibly enticing sort of option is limited because otherwise everyone would do it up to an extortionate amount. Pensions are always seem to be the sort of flavor of the month whenever there's an election or a budget. They keep changing the rules. But at the current point, you can contribute £60,000 per person, per sort of director. Obviously, talk to your accountant about this. And you can also do so for the previous 3 years. So you can use unused allowances over the previous 3 years. We would need to factor in previous contributions, and the allowances have changed over that time. But you can get quite a bit into your pension each year. So the monies are in the pension, they then grow free of tax. So no tax on the growth, no tax on the income. And then you have full flexibility when you take the money out at retirement. Some tax is payable, some tax is not. But hopefully at that point in retirement, you're not paying as much tax as you would when you were working. So you have a lower rate of tax. So the key there is you're in control, you're paying tax at a time that suits you, as opposed to if you take everything out, you're paying tax at a time that HMRC suits them. One point that I see coming up more and more often with our existing clients is inheritance tax and what's happened to pensions. So firstly, nothing yet. The legislation is just draft, but the way it sounds, it will go through, and it will kick in from April 2027. This doesn't destroy pensions. It just makes pensions part of your estate, much like a bank account, personal effects, cars, ISAs. Doesn't make them worse than that. It just brings them on par from an inheritance tax point of view. The difference with a personal pension is all of your monies they're never the pension companies. They go to your spouse, to your kids. They never just disappear. If we take through another example, say the NHS pension scheme, something that people will be quite familiar with, that pension is payable until the owner of the pension passes away. It then reverts roughly 50% to the spouse, and then it is gone after that point. If that pension is paying 20,000 a year, that's roughly $500,000 that is just kind of gone. So it's quite a good way of passing assets to the next generation. Less common, but better than taking money out of the business is investing within the business. You can hold monies within the business, you can grow them. The way to do this: investment account, investment bonds. And as you can see from the tax rates that I've got there, which were on a previous slide too, you're probably additional and higher rate payers now, but in retirement, you can bring yourself down to a basic rate payer. If you had to choose, you would rather pay 8% tax versus 33 or 39. So it's paying dividend tax at a time that kind of suits you. So then moving on to the next one is what do you actually do with these monies? We've focused on and spoken about the strategy, saving tax. But once they're in a pension or an investment account, what happens next? Does it stay in cash? Do we invest it? So I've got a quote here from Howard Marks. Fear and euphoria are dominant forces that drive the financial markets. Learning how to manage them is key to successful investing. There's always negative arguments for investing. That some of those voices seem louder at the moment. You've got issues with tariffs. You've got potential inflation. We've got Donald Trump. We've got geopolitical tensions all around the world. There's always arguments for not investing. We focus on sort of zooming out, looking at the bigger picture, because these arguments are not new. These things have always been around. And if we go to we're on the next slide now, so you can see all of the major sort of arguments to not invest over the last 20 years or so. You've got GFCs, you've got coronavirus, you've got euro debt crisis, and you can see in the blue line the equity markets just keep soldiering on. They have their blips, they have their corrections, but the further you zoom out, the smoother the returns get. Really important there as well is to focus on the lower end, the bottom right of that chart. You can see the difference between cash and inflation. And inflation has outpaced cash, and it's almost kept up with bonds. Sitting on the sidelines is not a good way to do things. So we do need to take some risk. We do need to get invested. Moving on, where do we invest? So we don't want to put all our eggs in one basket. We've got a chart here called the patchwork quilt. This is the 8 largest asset classes, give or take, over the last 20 years, ranking them from first to 8th each year. what you can see is the colors are all over the place. There is no common theme. There is no winner every single year. There is no same loser every single year as well. Diversification is key. If we look at the top right, you can see a lot of US equities there. There's been a bit of a trend, and people sort of jump on the bandwagon a little bit, which is another thing that we see a lot. They feel like everyone is making money in a certain area. They get involved, and then it's a little bit too late. This is happening actually at the present. The US has been dominating markets. However, this year it is Europe and the UK that are number one at the moment, and the US is actually down. As it brings up, I guess, opportunities, and this is we do have Donald Trump to thank for this. Moving on to this next slide here. So this also focuses on the importance of staying invested for a long period of time. People sit on the sidelines. They feel like they know more than others. They can time the market. They get in, get out. This is a damaging thing to do for your investments. No one can time the market to perfection over the long term. They might get it right once or twice, but what we've got here is a chart showing 100,000 invested for 20 years, turning into 710,000 if you just invested and sort of almost forgot about it. The next slide, or the next bar shows missing the 10 best days, damage that can do. You almost lose half of your wealth. Well, you do lose more than half of your wealth at that point, and then so on and so forth. Bringing it all together on the next slide is planning for the future. So we're talking about, this session has been very focused on trying to get the best returns, investing, saving tax, but what does it all mean? What's it for? Why do we want a £1 million pension? Why do we want to make sure HMRC doesn't take too much of our profits? It's because we want the options that money gives you. Those options are the option to go on holiday every month, the option to go down to 3 days per week, the option to put your kids through private school, to take time off whenever you wish. So what we do is, most importantly, is understand what do our clients want from their money. Do they want some of these things that I mentioned? How on track are they to get there? What work do they need to put in? Can we raise their ambitions and retire a little bit sooner? This is an example cash flow model for one of our existing clients, not named, obviously. Essentially, blue is good, red is bad. They're on their way to achieving their goals, but there's a little bit of work to do, and there's some ideas below of how we can potentially help. But that sort of sums up the key points that I wanted to raise today, and I'll pass over to Vicky for a couple of key takeaways.
No, thank you. I think, well, I'm invested in it all. I find it so interesting. So
Me too.
So yeah, just a few takeaways of today, really. So tax planning, again, know your dates, know what needs to be paid. Don't think, oh my God, I'm on holiday the 31st of July. I was supposed to do something. Have it in the diary. Even if you're going away, pay it early. Look at software. Technology is really, really, really coming forward, and it's saving people time. And it isn't just for big businesses. It isn't for clinicians that are seeing hundreds of patients. It's just as effective down to a smaller practice. And I think really, yeah, do the hard work now and see how much time it saves you going forwards. Staying in control, deciding the tax that you want to pay, as Oliver was saying, where do you want to pay it? Do you want to pay it to HMRC, or do you want to try and keep it yourself? And understand that you're the boss. This is your company. You are responsible for your own finances. No one else is going to do this for you. Get specialist advice. I know I bang on about it all the time, but people like Oliver are worth their weight in gold. Actually sitting with them, understanding and getting to the bottom of what is the most relevant for you and what's going to be not only the most tax efficient today, tomorrow, as Oliver was saying, 15, 20 years, 30 years down the line, ready for investment, to mature when you retire. And I really think, if you can work in unison with your accountant, with your IFA, you can be the most tax efficient. You can have the best, investments all along the route.
Great. Thank you, Vicky. Thank you, Oliver. That was brilliant. I learned a lot in the last 20 minutes. It's really fascinating to listen to you both. So we had a few questions sent to us beforehand, and do use the chat, please, or do unmute yourself if you'd like to ask Oliver or Vicky a direct question. Obviously, they'll be available after today as well if you want to set up a call and have a chat with them. But Vicky, I think I'll start with you on this one.
Yes, it must be for me.
Yes, why do I need to keep receipts for my business expenses?
So business expenses, if you can start having good business processes when you are small, you will have good business processes when you are large in terms of your company size. Keeping receipts is really important. Obviously, I know a lot of medical, specialisms are not VAT registered and they are exempt, but if you do come across any of the areas that are, you will need the VAT receipts to be able to reclaim VAT. But also for the purpose of your statutory accounts and your corporation tax, that actually you can go through, everything is coded correctly and it has a legal audit document behind it. As accountants, that really excites us and we're like, oh, we love it. And it will stop as well that, if there's something that we're trying to do in the accounts, we just know a name of a person, we don't really know anything more of it. We don't have to then go to you and say, on the 19th of February, you spent this amount, what was it? We've got a receipt for it. We know exactly that it was, staff training, it was your annual subscription. We've got that information there. So it's really important to keep them all. But obviously, if you use software, you don't have to keep them in paper. So you don't need these great big bags and boxes of them.
And what was the software you mentioned, Vicky? Was that HubDoc, was it?
HubDoc is the free sister software of Xero. It's an image capturing system that you can download on your phone. You can have an app. It does it on your computer. You can save it as a web page and you get a camera. So within it, you take a picture of your receipts if they're physical receipts, or if you have them emailed to your email, you forward them to a specific email address that is given within HubDoc, and it will actually upload into Xero. So at any point in time, whoever's doing your bookkeeping can go in and see there was, this is the amount that's come through the bank. Oh, there's the invoice for it. And it matches. There's no need to go to the clinician, ask any questions about anything. All of the information's there.
That's great. I've just downloaded that. So thank you.
Get out.
Probably one for Oliver, this one. Is it too late to start now? I've never invested before. I'm in my mid-50s or whatever. Is it too late? And, when I do start investing, how much of my income should I invest?
Yes, it's a good question, and it's something that I can see also has been added to the chat, a similar type question there. No, it's never too late. You can either ignore it or you can do something about it. If you do nothing, your situation will not improve. Obviously, the best time to invest was yesterday or 20 years ago, but the next best is obviously today. How much of your income should you invest? So this is where the projection software and a financial advisor really comes in handy, because obviously we know the most efficient way to save for your future is to never leave the house, never spend a cent, earn as much as you can, save everything, and you'll have a fantastic retirement. However, you'll have a pretty terrible life before then. So we want to make sure that you are doing enough for your long-term goals while also living life now. And we don't want to, you sort of don't want to be the richest man in the graveyard, as the saying sort of goes. You want to get it right. You want to enjoy life, but you also want to make sure you look after your future. And especially with sort of private medical professionals, if you'd previously worked for the NHS, for example, you turn up to work and it's going to probably be okay if you work your whole career there. You will put enough away. You will have that final salary pension, even after their best attempts to water it down. But after this, after the NHS, it is on you. So long way of saying, there isn't an exact number.
And Oliver, we can make your details available after the webinar. So should anyone who's attending tonight want to have a chat with you, they can
Sure.
do as a free of charge. There's a complimentary kind of
yeah, of course.
Call, yes.
Yeah. We go through a few meeting process to put a proposal in front of people, so they learn along the way and get a bit of a flavour of what we're for.
Okay, that's great.
Yeah.
Similar. When's a good time to invest? And you did cover this on one of the slides in terms of it seems to be there's always a good time to invest, but it'd be good for you to perhaps cover that one.
Yes. Yeah. And I'm gonna take this more from a markets performance type situation, because obviously the previous question's more about when's a good time to physically start contributing money and things like that. But when I get excited at times like this when there's been a bit of a correction. You see the market down in the US a couple of percent, and that is the best time to buy. You've got an asset that was full price a month ago, and now it's 5% off today. They're not necessarily any worse. You're just getting it at a discount. Money is not made when you buy at the top of markets. You don't buy high and sell low. You buy low and sell high. That is the ultimate goal of sort of business, and it's the same with investing. So when things feel a bit scary, that's usually when there's a bit of a discount going on in markets. But we also don't focus too much on timing, because you'll be kicking yourself constantly if you try and find, is today the bottom. You will just never know that, or if you may, you won't know it a second time or a third time. So when's a good time to invest? Again, yesterday. The next best is today.
Great, and perhaps you could answer the next one as well, which was we're all watching the news every day with the tariff hokey cokey with Trump.
Yep.
But with the UK economy where we are at the moment, and there's obviously been some announcements today too. Is it all bad news at the moment? What is there a sort of silver lining to the cloud?
Yes, yeah, I would say so. Well, so the Bank of England's not cutting rates today because wage growth is so high, and there's a couple other bits and bobs that are going on that cause that to happen. Rate cuts being cut at an aggressive, or rates being cut in an aggressive manner means the economy has gone bad. They need to step in and they need to help. The other part is, it's not sort of 1980, 1990 anymore. You can invest globally anywhere in the world very, very easily and very, very cheaply. You look at a portfolio 20, 30 years ago, and it is full of UK equities, and it's probably just full of M&S, John Lewis, Tesco, Sainsbury's, right? Some pretty stock standard high street companies. As you saw with that sort of patchwork quilt, yes, the UK may be down 1 year, but the US may be up another year, or in that same year. So you can diversify, and just because one area of your portfolio may not be doing so well, then other areas may pick up. In saying that, though, the UK is absolutely doing beautifully this year. It is outperforming the US, and we do have Donald Trump to thank for that one. So long may it continue.
Well, on that positive note, we may kind of finish the Q&A. Unless anyone else has got any questions they want to ask Oliver or Vicky, we can please use the chat or do unmute yourself. But if we haven't got any more questions, doesn't look like we do, then we will draw things to a close. Firstly, a big thank you to both Vicky and Oliver for joining us this evening. I hope you found that really fascinating. We've obviously recorded this evening, so we will be making it available both through email, but also through our WhatsApp group. So we'll send this slide deck round, so you can join our WhatsApp group, and which we regularly post tips, and we're trying to build a community really of private practitioners, so you can learn from each other and the experiences that you're going through. And month on month, we're getting more and more people attending that. So do join that. Obviously, we're always available. So info@designatedmedical.com is the main email address. Whatever your inquiry, we'll field it through to the relevant specialists within our team. So whether that's Vicky and Oliver when it comes to finance and accounting, or myself with strategy and marketing, CQC, we're getting a lot of CQC questions at the moment. So do send those through to us. And obviously our webinar series continues throughout this year. So we continue to run those. So our next webinar, we take a bit of a change of tack, and we move back to CQC. So Gabby Ashton, who has joined us recently as our head of CQC compliance, she has been both a CQC inspector and a consultant for a number of years. We'll be talking through preparation for a registration interview, and there have been some signs similar to what Oliver mentioned, that in recent weeks we've got clients that are seeing the waiting list come down for new registrations. And are seeing a relatively quick turnaround, I think, compared to previously. So we'll be talking this one will be about the registration interview with CQC. So how to be interview ready, understanding the quality statements, demonstrating that this kind of templated approach is not the way forward, and you will get found out. So how you need to bespoke your policies and procedures for your practice. Knowing your statement of purpose, and that links very much back to kind of strategy and your value proposition, which you hear me talking a lot about. And then we're looking at some sample interview questions. So just really giving you an idea of the type of questions you'll get asked. And this registered manager interview is it's not for the light-hearted, faint-hearted, I should say. That we had a client who went through his interview last week. It was 3 hours, and it was fairly rigorous. And I think one of our attendees tonight has recently had a CQC interview as well, which was just over 2 hours. So helping you prepare for that interview and making sure that you're successful. So I think that'll be a really good session. Like I said, we get a lot of questions at the moment about CQC. And then following on from that, we'll be talking about your first year. So once you get through CQC registration and you're successful, what does that kind of first year look like for you? What about ongoing compliance? One of the things we preach a lot about is the importance of preparation. So, just because you've got through CQC doesn't mean you can kind of rest on your laurels and feel like you're in the clear. You do need to make sure you stay on top of things, and it's best to do that on a monthly basis or a quarterly basis. So when you get that email that comes through, and typically the CQC do say that they will inspect a new practice within the first 12 months. You are well prepared, you've got everything in order, and you can relax going into that kind of first inspection with confidence and competence. So a couple of really good webinars coming up in April and May. We will announce what we're doing later in the year, probably towards April and May, about what our next series are going to be. But if there's anything you want to hear about, then obviously do let us know, and we can build that into our program. So all of the recordings are available. If you do want to see those, we can send those out to you in a PDF, and you can watch them in your own time. But if we've got no further questions tonight, I'll just check before we finish. No further questions. Then we'll draw things to a close. Again, a big thank you to Oliver and Vicky. Brilliant presentations. I learned a lot personally, and we will see you again next month. Thank you
for having us.
Thanks.